We hopefully are live to you on Zoom if you've joined us there, or on Facebook. It is the 23rd of March, 2022. We're almost a quarter of the way through the year. It's still sunny here in Melbourne, which is nice change. It's normally very cold, so it's great. I've got some sunshine on my face coming through here, which is a very, very nice change for this time of the year. Hopefully all of you are settled down. You've got your sandwich out, got a drink, whatever it is. We're going to go for about 45 minutes from here. And I really encourage you to try and get rid of all the distractions that you've got around, because if you do focus, get involved and give me your undivided attention, then you definitely will leave today's session far better off than when you are right now. So if you can, try and get those pesky co-workers away, or alternatively, turn the screen around and get them to join in with you as well, and settle down. Make sure you've got a drink and something to eat so that you don't feel too parched as we get going. All right, I really was just wasting time to make sure that all the tech was working and everyone was dropping in. So hopefully you can all hear and everything is good. If you can't, drop something in the comments and we will try to get on top of that. I know over the few weeks we have had some issues with sound with our second guest coming in. I believe we're going to be all over it today, but I don't want to make any promises. Okay, as always, just to get you started, and really, I guess more of a thought starter is the problem. Now, every single one of you will either be suffering from this or have suffered or are suffering in part from this. And that is, it is a really, really simple issue that all of us as homeowners come across at some point in our life and may still be struggling from it. And that is, how do you buy a home that you can afford, that is right for you, add long-term value to your life without making a mistake? Pretty simple, isn't it? But it is time and time again. Every time I meet someone new, they always tell me this is their problem. Oh, I'm not sure. Is it the right time? Is it the right location? Am I paying too much? How do I know that this is going to continue to drive value? Is it here? Is it there? And there are so many reasons, but ultimately it's because you're suffering from this problem. And that's okay, because you're not alone. Everyone suffers from it. The good news is there is a solution. Now, before I tell you about the solution, I'm not going to solve it for you today. But what I've done over the last few decades is I've created a framework that helps you manage through each of these. And ultimately, it's all about giving that back to you so that you can be master of your own destiny. You can understand when you're coming unstuck. You can identify which one of these pillars in my three-part framework you need to focus in on, and how you can get unstuck and move forward so that you don't suffer from that. And this is something that you can do over and over again. So I'm going to run through it really quickly. As I said, there's three parts. Number one is find, okay? Now that's the first pillar. Now what I mean by that is you need to find the right property. So pretty simple. I think all of us kind of understand that. Is it big enough? Is it in the right location? Has it got the right mix of bedrooms? Should I be looking for this? Do I want a garden? Do I want an apartment? Do I want a freestanding house? Everything that we know, and pretty much I'm sure most of you will be there. But you've really got to think about it, not only in the context of what you're looking for right now, but what you're looking for in the future, and does that fit in with your needs? Now, it might be okay if it doesn't, but then you need to be aware of that so that you do understand as you're going through and refining and re-looking at this, that you made a conscious decision at the time that this was a stepping stone to perhaps your next home, and that it wasn't meant to satisfy all of your needs, okay? Number two is finance. Now, this is probably one of the most forgotten things in owning a home, okay? Now, when I say forgotten, we all know, or for very few of us out there, can actually have enough cash to pay for a home all by ourselves. And the great thing about owning a home is that you can go to any bank and get them to give you their money to help you buy the home, okay? We call that other people's money. So whether it be a bank, whether it be family, mum, dad, cousins, brothers, uncles to lend you the money, whether perhaps you buy the home in partnership with someone. So, traditionally we always think about husbands and wives buying it, but it could be your brother, your uncle, your cousin, even friends. You could be buying it with your parents. That's a great thing about owning a home. There's every different way that you can potentially use other people's money. Now, why do I say it's so forgotten? Well, people tend to think about how they're going to fund their purchase after they've found the right home. Most people, even after they've signed the contract. But it's best to bring finance forward. Think about it as the first thing to properly understand how much you can afford, how you're going to do it, and identify if that budget isn't enough for what you're looking for, then you need to work out how can you expand it. And if you can't expand it, then you need to think about refining what you're looking for to fall within that budget. Otherwise, you end up wasting a lot of time. And that is one of the main reasons why I see people struggling, because they have champagne tastes with a beer budget. Now, I've fallen into that trap with everything, okay? Everything I do in life, I have champagne taste and a beer budget. Whether I could afford more, I'm a tight ass, I can't help it, I don't want to spend the money. So don't fall into that trap. Okay, number 3 is manage. Now, if you're an investor on the line today, you'll think traditionally when I'm talking about managers, how are you going to manage that property? You know, who's going to find your tenants, who's going to look after the maintenance, who's going to collect the rent, who's going to pay the outgoings, and all of that is great. And yes, that falls into manage. But manage is more than that. Whether it's a home you live in or an investment property, is how are you going to look after that asset? Because for most of you, this will be the single biggest asset that you're ever going to have in your life. So how are you going to manage your time? For example, if you buy a property that's a knockdown or needs a major renovation, how are you going to manage your time to actually carry out those works? You know, I see a lot of people fall into the trap. You know, they watch home renovation shows, which are obviously highly edited, and there is a cast of thousands behind these people doing all the work. And they think that's pretty easy. I'll buy a knockdown, something that needs a major renovation, and I'll knock it out in 6 weeks. Only to find 6 years later, they're still living in the same dump and they really, really have grown to hate that home. So you need to understand, manage your skills, your time. Is that right for you? And for most people, it's not. The dream sounds great, but for most people, they want the home to be somewhere that they can enjoy, spend their family time. So you've got to think about things like that. Also managing your overall process, you know, looking after your finance, going back and checking, is that still the best? Thinking about how you might upgrade your home or change it to meet your changing needs or the changing needs of the market. So really, really important. And again, an often overlooked thing. So they're the 3 pillars in the framework: find, finance, and manage. Now, this isn't a do once and set and forget. What you need to do is you need to do it over and over and over again. So it doesn't matter whether you already own a property or you're looking to buy a home. This is something you should constantly be doing and re-looking at, because it is always something that will help you get the most out of that home. And that is how you'll slay the problem that we had before, by continually looking at it, refining it, and knowing when you should be making these changes. All right, now I've been chastising you for a while. For those of you that don't know who Salvo is, we do a lot of different things, but ultimately everything we do is all about helping you create a home. And all within this framework of these 3 pillars. We live and breathe this every day. It's what we love doing, and we love helping people like all of you on the line. Myself, I've been here for about 13 years. Love it here, but I didn't start out this way. I did have a very simple telemarketing job probably about 20 odd years ago. And I tell you this because it really gave me a foundation to understand what it is that people are looking and why owning a home is so important. So, telemarketing, it's a thankless job. It was even worse 20 years ago because you were calling people on their landline. So you really were in their homes. No one wanted to talk to you. They constantly hung up on you. What I learned through this is that ultimately people, they weren't hanging up on you because they didn't like you. They were hanging up on you because we weren't delivering value. So if we could put across a value proposition before they went to hang up, they'd often listen and go through and understand and say, yeah, okay, tell me a little bit more about that. Now, fast forward to where we are today, and we build thousands and thousands of homes every single year, and we help create these homes for people like you and I. So it's a very, very different prospect today for me personally than it was 20 years ago. But what I learned through that is that people want value, but ultimately they want to be able to take back the control themselves. So what I mean by take back control is understand what it is that they're looking for, understand how they can drive that value, and how they can actually go out there and when they see it, don't get stuck and make those decisions. Because remember the problem we talked about? You don't want to be stuck not moving forward because you're worried about whether it's right for you. So you want to be able to take back control, understand why, use this 3-pillar framework so that you can go out there, you can execute, and you can create that new home that you're desperately looking for. Okay, so that's it for the introduction. Today, what are we going to do? Well, as I said, we'll go for probably about another 30 minutes from here. I'm going to break it down into 3 sections. So section 1, I'm going to give you a quick roundup on the weekly news and what I've seen happening around the countryside. I'm going to have a timer, 90 seconds, so it will be quick and it will be fast. Section 2, again, all about taking back control. This week's focus is investors. But if you're on the line and you're not an investor, don't hang up just yet, because there's something here for everyone. So it doesn't matter where you are on that spectrum. The principles that we talk about today are just as useful if you're just looking to buy your first home for the very first time, right up to the other end of the spectrum if you're buying your 3rd or your 4th or your 5th investment property. There's something here for everyone, but we are focusing in on what we're talking about here for investors today. That'll go for about 20 minutes. I think we've got 3 guys coming on, so I'll try to keep it short and sharp. And if you've got any questions, obviously put it into the Q&A. If you're on Facebook and watching it there, drop it in the comments. We may not be able to get back to you live. I know a couple of the guys are monitoring that. If we don't, we will come back to you after today's session. And then before I let you all go, you've probably finished your sandwich and your drinks by that point. I want to just summarize quickly in a couple of minutes, where to from here. So, a lot of people always say to me, well, that's great, but how do I move forward with your framework? How do I actually apply that to my own situation? And I'm going to map out a little bit of a roadmap for you as to how you can move forward from there. All right. So, news. Let's get stuck into it. I'm going to start the timer in a minute, and I'm going to quickly run through. If I do go over time, it will stop me. And if I think there's something important, I will bring it back. Otherwise, this will be short and sharp. So give me your undivided attention right now, and I will start that timer. Okay, so what have I seen happening around the countryside? These were my top 5 stories for the week. Perfect storm of factors means an apartment price boom could be looming. Now, to put that simple, we've obviously seen huge increase in freestanding home prices over the last 12 months. Apartments, not so much. They've been okay, but haven't followed quite the same trend. Now, that's meant we haven't built a lot of new homes. We're going to talk about investment property, but it does take anywhere from 2 to 5 years to build an apartment complex. So we do expect to finally start seeing a shortage of supply, which will drive prices up as the increasing demand once we start all of the migration and overseas students coming through again. That's slowly starting to trickle in. Struggling CBDs set for renewed growth as demand for city rentals surges. We're going to be talking about that in a minute, so I'm going to skip over that. 6 ways that COVID has shaped the housing market. I think we've touched on this a lot, but it was interesting to sum it up. Obviously, the regions have got a bit more of a look in. People have talked about working from home as a regular thing and how do they fit that into their lifestyle. And obviously, all of the government incentives that have come through have really changed the way that people have been buying. John McGrath, legend, made some observations about the East Coast market. Ultimately, he said we're still in for probably another good 18 months of solid growth, and he doesn't think things are going to fall down. What's the difference between an appraisal and valuation? I think I'll save that for another session. 2 seconds, auction results. We had, time is up, I believe it was about national clearance rate of 76.8%. In Melbourne, it was in the, I think 68.9% and 69.7% in Sydney. So definitely come off from the high 70s and 80s that we were seeing all throughout last year. But I just want to make this point for you. Anything above about 60 to 65% is still a really, really strong market. When you couple that with those of you that have been listening for a long time will know, Sydney had 1,005 auctions, Melbourne had 1,504 auctions. So that is a big, big number regardless. And I don't think Melbourne, other than the odd public holidays and the Christmas shutdown, for probably the last 9 months plus, those of you that are statistics gurus will tell me I might be wrong, but I'd say pretty much for the last 9 months solid, we've always had more than 1,000 homes going to auction and seen those great rates. So just to remember, there's a lot of homes going through and still really, really good results. And that is why John McGrath doesn't think that things are going to be falling down. It's still going to be quite strong. And so do we here as well. So those of you that are like Chicken Little and worried that the sky is going to fall in, I don't think it's going to happen. And I think that you need to just look at what's going on and take a bit more of a broader and long-term view. Okay, I think I did pretty well. Obviously, I had to skip back on those slides because I did want you to see those statistics. That is it for the news. We're going to move into our first full session. Now, as I said, we're going to be talking about investors. So to get us started, Greg's going to come in and talk to us all about rents, rental market and CBD rentals. So Greg, hi. Good to see you again.
Yes.
Grab a seat. Yep. Now, people have said they don't like my language, but I'm going to say it again. Rents have been shitouts for the last sort of 2 years, haven't they?
They've been absolutely crazy. When you consider probably this time last year, or on the first lockdowns, Melbourne specifically lost nearly 30% in rentals, which is huge.
Yep. So I've been crying to everyone in the office, and none of you listen to me, none of you care, but I know that this year has really been very different. I think you guys had some vacancy across the 4,000 odd properties that we manage, yep. And that was all gone within the first few weeks. You know, we've just got the traditional changeover now.
Yeah, initially we discussed this before. There were a lot of people who were starting before the borders opened. Well, actually starting to move back into the city because of the affordability, and that has allowed, and we'll get to the other point as well, where the market's starting to raise without the borders opening.
Yep. With
that opening, and we've seen the last 10 weeks, I'll get to that now, we're going to see, I think we'll see some really good growth.
And so, you know, it's always important that we talk about, you know, and I've mentioned this a few times, you know, I call it year 7 economics, which is the simple demand versus supply.
Yep.
And I guess what a lot of people perhaps don't quite understand is that whilst it was definitely a demand-driven sort of reason why we saw these rentals drop and the vacancy go up so much, yep. It was kind of a forced lack of demand by the changes in policy, yep. The fact the borders were shut. All the lockdowns and so forth.
Yep.
So, you know, what's happening now, fast forward 2 years, what's changed and why are you so positive and why should we be all excited? And you're telling me I should stop getting upset with the property managers now.
You should start relaxing.
Okay. I think it's not going to happen, but yes, I will try.
I think we're going to start seeing, I mean, pre-COVID, we was getting some really good returns, 5+% on average. And obviously that dropped quite substantially, but we're starting to see that grow back up. A key factor that people look at in the last 10 weeks is who's looking at renting.
Yep.
And we've seen the last 10 weeks on a national scale, that's increased by 27% of people actively getting on platforms like realestate.com looking to see what's for rent.
So that's really where you're sort of saying that demand has significantly spiked.
Yep.
With
compared to this time last year, nationally, it's up by 27%, 46% in Melbourne. Okay. So this time last year, the amount of people in the last 10 weeks looking for inner city properties to rent increased by 46% in Melbourne. And that's huge. And that's people, you know, they're looking now for, and we're already pretty full where we are. So that's all going to be good in terms of demand, people wanting to come in and rent property in inner city.
Good. Yeah. All right. Now, what are you doing still sitting here? Go get me more rent on my properties. It should be as easy as that, shouldn't it? I'm sold on what you just said.
But as you say, it's going to feed through. And I think that's a very good time. We know Lucas will come in and talk about investment, but absolutely, it's a perfect time. We get to see some good growth coming through.
Yeah. And I guess, you know, whilst that's really good to hear and sort of see, you know, you guys are seeing it firsthand on the ground, which is always nice because whilst the economists and statisticians and so forth are great because they crunch these numbers and they have big data, there's no substitute for getting your hands dirty. You know, I talked before about smelling the asset, living it, feeling it.
Yep.
So it's good to get that from you firsthand.
Yep.
But I guess we should caution people like myself that are getting excited thinking my rents will go up, that, you know, if I've got a lease for 6-12 months, I've got to wait till the end of that lease and then maybe might creep up.
And even then, James, we're saying if you've got a good tenant, don't go crazy and then it's right. And raise the rent.
Get back my 30% I've
So
lost.
then
Maybe I might only get 5, 10%.
step by step, but ultimately we're going to get back to those returns we were seeing before. And specifically in locations like where we are, where you've got everything around, the demand is going to be good. But yeah, it's looking exceptionally good. Interestingly enough, a lot of the inquiries are coming out of places like the UK, USA, followed by Indonesia, New Zealand, and India. So it's a bit different.
Okay, good.
Yeah.
And I guess it's the old hare and the tortoise story, like you've told your 25 million kids you've got there, that slow and steady wins the race. So don't try to get those rents up straight away. Just accept that it's going to take a little bit of time, but that you're going to win in the long run. Because
but ultimately we're going to get back to where we were. So getting involved in investment in, I think, in apartments is still the wise thing.
All right, good. Yeah. Now go make a few other landlords happy. All right, so I want to segue across now to, now that we know that the rental market is looking a little bit better, the negativity has started to go away. We're starting to see some really good, grass shoots happening out there in the market, particularly in our CBD markets of Melbourne and Sydney, where 70, 80% of the rental properties are located. Let's move forward to, if that sounds good and you're not already an investor, or perhaps you're already thinking about it, what are some of the key things that you need to do? Because we all know that one of the key drivers to financial freedom is having an investment property. It's something we love. We talk all the time. It is the great Australian dream. And it doesn't matter how much negativity there might be out there. We all want to own our own home. And once we do, we want more of it. We're like addicts. Once we own one home, we want a second home, a third home, a fourth home. So Lucas, come on in. Now, tell me, my friend, did I steal any of your lines? Am I going to steal any of your points today? I'm going to try and be quiet.
I was laughing.
Let's have a seat.
I was laughing when you were talking about the path to financial freedom is property investment, because that's how I was going to start, actually.
So break it down for all our listeners out there. If you want to, we have talked about this a few times over the last 12 months, but if you want to be an investor, what are some of the key steps or things that you need to do to make sure that you go down that journey successfully?
Yeah, look, James, first of all, you got to sort out your money. You need to work
Sounds like one of my pillars, doesn't it?
You need to work out your commitment funds from your income and separate the surplus money. So that way you know how much money you got to invest into a property. So because property is more of a long-term thing. So those people that say, I got a few dollars left over, I'm going to buy property, sell it quickly and make a killing, that's very dangerous. It's speculating, and this day and age doesn't work like that.
Get rich slow.
That's right. Slow and steady wins the
race. In fact, I think that's what we were just talking about with Greg, wasn't it? The hare and the tortoise.
Now, second thing, it's also a little bit similar to that, and it's calculate what you can afford, not just today, but also tomorrow. So, you have to take into consideration, interest rates might increase. You might get married and have a family, so your expenses might increase. So always don't just work out what it is you need for today, but also for tomorrow as well.
So those of you that were listening to my introduction, that's the manage part. Think about where you're going, think about what's happening in the future, and make sure that you get your strategy right. All right, I like this. You're making me feel good. Colin's been doing this the last few weeks, telling me what a great job I've been doing. Not really, but ish. All right, continue on. Give us a few more.
You got to choose yield or growth. Okay, so when you're using growth, it's how much money the property is going to make you after you sell it. Whether yield is how much money the property can make you from rent ongoing. So this is what I like to say. Why would you sell the goose that's laying the golden egg, right? So if you're having a good yield and it's making you money ongoing, why would you ever sell it?
I think that's one of the most misunderstood principles everyone's worried about. And I know we're going to talk about some taxes later that might skew this view a little bit for people. But, someone once sort of said to me is there's no point in going for capital gain and growth if you can't pay for it. So, you need to have that yield. You need to have the daily cash flow, the monthly cash flow, the annual cash flow in order to be able to hold that property to benefit from the capital growth. Because like you said, understand what you can afford today, tomorrow, in the future, because it might be, you know, for a lot of people, they've seen huge capital growth in the last 12 months, but they might not have seen much for the 5 years before that. And you need to be able to hold it always, as we say, over the long term, which is why yield is perhaps one of the most important things. And many people came unstuck, I think, during the GFC with that as well, not having the cash flow to hold their properties.
That's right. That's right. Look, lastly, research, don't search. So don't get up just browsing. Check things like supply, demand, future capital growth, yield, infrastructure, and the most important factor, which is location.
Golden rule of real estate.
That's it. That's my sort of 4 tips.
Okay, so I've got a lot of questions coming through here, and most of them are quite specific in terms of, you know, should I do this? Should I do that? So perhaps to help all of our listeners, could you maybe break down, and sorry, for those of you that have asked direct questions, we will come back to you with specific answers after the session ends, but it might be useful, you know, are you able to sort of more generally sort of explain to our listeners ways that they can tell if they are doing a good job, or, you know, they're thinking correctly like an investor should be, and or, you know, signs that will let them know that they're perhaps not on the right path and going down the wrong avenue?
Okay, so obviously the 4 things we mentioned are signs that they're doing the right things. Signs that you're not doing the right thing. Well, number 1, you're not considering location. That's
Okay.
number 1.
It's the opposite.
You know, you're not looking at the numbers, which is rental return, cash flow, how much money you require to put into the property. So it's basically the opposite of what we previously mentioned.
Yep.
Another one is you're not thinking about the little details. Okay, you need to put yourself in the tenant's shoes. You got to see things that they love about their location, the amenities. Could be views, little conveniences like dishwashers, gas cooktop instead of electric, internet. You know, those are the kind of things that you need to be considering as well.
Yeah, and I think you've talked about that a lot in the past, where we say, you know, you've got to think of it like a business, and the tenants are your customers. You know, most of our listeners might have their own small business, might be a big business even, or work in a business, and you know that the customers are key, and you know, the customer is always right-ish. You know, that we really need to think about it like a business, think about those customers, which are your tenants, and what you can do to make it bigger, better for them. And that ultimately will translate through into that, not only the growth, but the day-to-day income you're talking about.
And I guess the last thing we can say is you're not getting professional advice. So don't listen to unqualified families and friends.
What about the local taxi driver?
I was going to say, oh, you're very friendly Uber. Yeah, it's all
Okay.
about Uber. Or you're very friendly Uber driver. Okay, choose advice wisely and only deal with professionals and experts, such as ourselves.
Of course, of course. And look, I think that's one that's hard, because, you know, a lot of people, I guess, a little bit cautious about people that say, this is what I do for a living. But ultimately, you know, if you combine professional advice and you understand the framework I've given you in terms of the pillars, and you can take back that control, you're able to understand why the professionals are telling you what they're telling you and apply that to your own circumstance. And really, there's no substitute for first-hand knowledge and experience. You know, we talk about speaking with a local agent in your area because they're experts there. You know, we just mentioned with Greg that it was great to actually get his view on what he's seeing happening as he's talking to people, and he's on the street, he's doing open houses. That you know, you can't substitute that for just reading and, or as you said, the local Uber driver, because they're not there, they're not on the ground. They're going to be perhaps giving you yesterday's news, and it's all about today's news and tomorrow's news, which is how you do move forward positively rather than living in the rearview mirror.
And most of them don't have multiple investment properties either.
Well, that as well, despite what they often tell you.
Correct. So that's pretty much it, I think. You know, so especially the opposite pretty much of what we mentioned before. And it's very simple as long as you just do the right things, go down the right path, and it's quite simple.
Good. All right. I know there's a lot more questions come up there. We will sort of get back to you if the guys haven't already answered them for you. because I want to talk about taxes. So I want to let Lucas go. So thank you.
Thank you. Pleasure.
So tax. There's only two certainties in life. We've all heard this before: death and taxes. Now, it's an ugly word. No one likes it. It isn't that much fun, but it's something, not only is it important in everyday life, but even more so when you're an investor and when it comes to investment property, is that you need to understand what are the taxes that may apply, because there are different taxes and there's more taxes, but also how you can minimize those taxes or even use them to your advantage. So I'm going to bring on our CFO, Derek Chung, who's going to join us. Come in. I think
Thanks,
is this your first, grab a seat. I think this is your first session with us in the new look.
Yes.
You were just grabbing your abs, was it? Because we did, for those of you there, we did have a big workout session this morning. We talked everything about tax. We pre-designed this. And I tell you what, we're kind of flying by the seat of our pants a little bit here. We're both chartered accountants, so we deserve to do that because it was a big session. We were out of breath and we hardly were able to speak. But, sort of tell us, I think it'd be good. First of all, let's talk about, income tax. Everyone knows a little bit about that. So let's just park that for a moment.
Sure.
What are some of the one-off taxes that are specific to real estate that people might not know about?
Yep. So like you said, Australia is a very high tax country. They have taxes like from the ATO, and they also have a separate tax from the State Revenue Office, which is called the stamp duty. And that stamp duty applicable when you buy whether a brand new or second-hand property. And if you're buying as a first home buyer, you may get a little bit of concession from the government. But if you're buying it as an investment, the rule changed. Okay. So that is a once-off stamp duty, which could be in between 3 to 5% of your purchase price.
All right. So, I did do a big session, I think, with Greg a few episodes ago. So we won't go into too much more detail on that. But stamp duty is like the door charge at the nightclub. You've got to pay it if you want to get inside. So you want to buy a property, you've got to pay it. So it's important that you understand that, you factor that into your calculations. There are ways to minimize it. We're not going to take up your time today. Do go back. I think it was about 3 or so episodes ago. We even had the whiteboard and ran through that. Have a look at that and that'll give you plenty of insight. Okay, so if we think about then ongoing taxes, what are some of the other taxes other than obviously income tax that are specific to being a property investor that you might not have thought about before?
Land tax.
Taxes. I thought he was going to say there are no other taxes.
No, land tax.
So in a simple view, what is land tax?
So land tax is applicable or is payable or based on the land value that attached with the property that you bought. So the concept behind it is like, say, if you're buying a house or you're buying a townhouses, the land portion of that property, the purchase price, let's say it's worth $1 million. The land.
Now, my friend, I've got a whiteboard. Come on, hop up. Let's have a look. While you're explaining it to people, I'm going to do some numbers here. So land tax, you're saying, all right, your property you've purchased for, say, $1 million.
Yep.
Do you pay the tax on that?
You pay the stamp duty on that's correct.
Okay. So you've got stamp duty on here.
Yep.
And then the second thing that you've got is land tax. And land tax we're paying on the purchase price?
No, land tax is based on the land value, apportioned by the purchase price. So let's say if you're buying a townhouses, the construction cost for the townhouse, let's say it's $500,000, and the government thinks the land worth about $500,000, then your land tax is payable on that $500,000 of the land price that contained within the contract, the cost.
Okay. So without going into too much detail, it could be, if you had a vacant block of land, it could be as much
Correct.
as $1 million.
Yes.
And really depending on the type of property you've got, it may change. So, we often talk about one of the great things about apartments is that the land component, as far as the State Revenue Office is concerned, is a much smaller value amount. So, on something like this, it could be as little as, 100,000.
Yep.
And so this is a percentage-based tax.
Correct.
And what's the rate roughly?
I think from memory, that was about 2.
2%.
Yeah.
Okay. So, you know, it could be quite big. It could be a little amount depending on what you're doing.
Yep.
You want to?
Yeah, no, so we don't just, the benefit of buying an off the plan or an apartment is this land value, using that as an example, let's say the land value is only $100,000. Usually you're below the threshold that is applicable for land tax purposes. What it means is like there's a threshold. Until then, you don't pay any land tax until you went above the threshold. So
it's just like our pay, where we can earn the first
progressive tax.
$20,000 tax free.
Yeah.
You're saying there's a tax free threshold as well for land tax.
Correct.
So potentially,
Yep.
whilst this is a tax that investors should be thinking about, depending on the value of your underlying land, it potentially could be 0.
Yep.
Okay.
Exactly.
All right. Well, there you go. A tax that you potentially could avoid if you don't spend too much. Now, for those of you that have got 5, 6, 7, 8, 9, 10 investment properties, you probably know everything about land tax. Those of you that have maybe only got 1 or 2, quite possible that you don't even have to pay land tax.
That's right.
All right. Now, let's get to the big one, income tax.
Oh, I love income tax.
It's everyone's favorite.
Yeah.
Not. No one likes paying income tax. Now, can you sort of just explain to us, because I know I'm going to keep the iPad because I know there's going to be a lot of questions coming through, but we just think of tax, right?
Yep.
As an average person.
Correct.
But as us esteemed chartered accountants, there's a few different types of taxes. So can you perhaps sort of tell everyone the different types of taxes and maybe just high level explain the difference?
Sure. So we spoke about the stamp duty, we spoke about the land tax. Now we're talking about the big taxes. So generally, when you buy an investment property, you got to face 2 different types of tax. One is the income tax.
Yep. Okay. So one is income tax.
Yep. And the second type of tax called capital gain tax.
Okay. So 2 different types of taxes.
Correct. Yep.
What's the difference?
So the income tax, look at it in a way that when you have a rental apartment, you're running like a business. All your rental income will be considered accessible for tax purposes. But however, while you're renting your property out to a tenant, you will incur other expenses such as owner cost fees, interest on your mortgage, land tax. Those are the expenses that you can go against the income that you earn from your rent. So this is
income tax is really for your rent.
correct.
Okay. And capital gains tax, what's that?
The capital gain tax applied only applicable when you're selling your property at the end.
So that's on the growth,
So correct.
if there is any.
And yeah,
Now, tell me, who cares? All right. My spelling is atrocious.
I didn't
Now-
want to point that out, but that's okay.
Why is this important to understand the difference between the 2?
So you pay a percentage of income tax. Like let's say your taxable bracket is about 30%. And if your total rental income less rental deduction for the year is say $10,000.
Well, just tell us. So if it's 30% here,
Yep,
what's the tax rate? for
half
capital
of that.
gains?
Call it 15%
So you're only paying 50%
of the 30%.
which is 15%.
Correct.
Okay. So simple thing for those non-accountants on the line, I want to pay half the tax.
Easy.
Okay. Let's just pay it 15%. So do I just write and say, dear Mr. ATO, I will pay capital gains tax and not income tax?
No, you can't do that.
Okay.
I wish we could, but you can't.
All right. So, you know, if we want to move towards paying capital gains tax, or there's got to be ways that we can, you know, minimize the amount of tax that we pay, even at least defer the tax that we pay.
Correct.
So what are some of the ways that we can access more of this lower rate versus a higher rate, or just anything that we can do to help minimize the amount of tax we pay? Because I don't think any of you want to pay more tax. You know, we all know the famous line from Kerry Packer about why would I want to pay more tax? Because you're not doing a bloody good job with it to start with. And I think that's still relevant today. No one wants to pay more tax, right?
Correct.
I hate you because you're constantly taking tax. The amount of tax we pay, not only on our personal incomes, company tax, land taxes, payroll taxes, there's more taxes coming at our ears than we know. How do we minimize tax? What are some of the ways that people can do it?
Just remember one thing, depreciations.
Depreciation. Okay. So depreciation, what is it?
So basically it is, when you buy an apartment, there's two components within your apartment. One is the construction cost, and there's also plant and equipment. The ATO basically allowed a taxpayer to slowly deduct those amounts on a yearly basis. So let's say if you buy an apartment for $500,000, and once you get a qualified quantity surveyor to give you the depreciation schedules, the annual deductions might be around 10 to 15,000 each year. That goes against your income. So,
okay, 10 to 15,000 per annum.
Yep.
Now, I understood everything you said, but you know what? For most of my listeners, they didn't understand a word you were saying. It was technical, it was hit. I'll put it simply to you. Think about it. You buy a fridge every year, it gets older and older and older, and after about 5 to 10 years, you throw it in the bin. Now, the fridge in your home, you throw it in the bin and that's it and it's done. What Derek was talking about is that if you're an investor, you pay for that fridge on day one, okay? Then every year, as it gets older, you can deduct a percentage of that fridge. So let's say in simple terms, it was a $10,000 fridge, bloody expensive fridge, but I'm doing this for the simple maths. And on a very simple basis, we said it would last for 10 years. Every single year, you can deduct $1,000. So you add up all those expenses, and that's how you get to this figure here.
done by the, yes, correct.
Yeah. Now, obviously, you need a professional, a quantity surveyor. There's a lot of paperwork that needs to be done around it, but that is a big, big saving. So, you know, can we perhaps do a worked example? You know, let's say that we have, you know, let's say in scenario one,
Yep.
you know, we don't have any depreciation. Scenario two, we do.
Yep.
So let's say the rental income is $30,000. Okay. We have expenses, you know, council rates, taxes,
All add up.
water rates, whatever it is, of say $10,000. Okay. So we're left with $20,000 in our pocket at the end of the year.
Yep, before
Okay.
depreciation, correct. Yep.
So in our scenario one, where we don't have depreciation, we're going to pay tax. Now, I don't have a calculator. I'm going to assume for the time being that you're paying 50% tax. Now, those of you smart people out there will know it's actually 47.5 or whatever, but we're not going to get that technical hit.
Yep.
Simply half the tax. So you are going to pay to the tax man $10,000, and you're going to be left in your pocket with $10,000. Okay.
Correct.
Great.
Yep.
I've got 10 grand. Go spend it on a new car, holiday, whatever it is. Fantastic. Now, depreciation comes in before the income tax.
Yep.
So what do we say? Let's say we have $10,000 worth of depreciation.
Yeah, conservative.
So you're saying we take off $10,000 of depreciation.
Yep.
So now we end up with $10,000. Now, before we go forward, it's really, really important distinguishment to make here. That $10,000 of depreciation is what we call a non-cash expense. Now, the reason why that's important is you don't have to pay for it. You already paid for it when you bought the fridge, when you bought the building, when you bought the property. You know, whatever it is that you brought, you've already paid for it. So you're getting a deduction of $10,000, but you don't have just $10,000 in your pocket. You've still got $20,000 in your pocket. Now we go to pay the tax, and we're going to pay half. So we pay $5,000. We end up with $5,000 in our pocket, plus we've still got this $10,000, which means all up we have $15,000. Okay? That is the power of depreciation, because I tell you what, whatever car you're buying for 10 grand, You can buy a hell of a better car for 15 grand. You can go on 2 holidays, perhaps even. And it hasn't cost you anything. Okay, simply a bit of time to get this all set up, do the paperwork, get it right. And it's a really, really great strategy there. Not only are you paying half the amount of tax, who's not happy with that? You're ending up with 5 grand better off in your pocket. So really, really important distinguishment there. And I think hopefully the numbers help provide you a bit of a better understanding as to why that's so important. Now, it's not all roses when it comes to this.
Correct.
Because it does come back eventually. So upset everyone. What happens to the 10 grand? Because they haven't paid for it.
Yeah. Or you going back to the $500,000 apartment example, what happened is you claim a $10,000 deduction as a depreciation in your tax return. So let's say you bought the apartment for $500,000. So your cost base now is going to be reduced from $500,000 to $490,000. So let's say if you're selling the property right away at the market value, which is also $500,000, you would crystallize a 10 grand of capital gain immediately. However, the good news is capital gain is only taxed at 50%. So what it is you're basically just paying 15% of the 10 grand profit, which is about $15,000. Comparing of paying additional $5,000 tax year, you save $3,500 immediately just by deferring and using depreciation as a weapon.
Okay. Now, again, you might be lost with that. I'll make it really, really simple. Get a good accountant. Lucas said before, get professional advice. Unfortunately, he's too expensive. We pay him far too much. But remember what Lucas said to you in the session before? He said, you've got to focus on the right mix of cash flow versus growth. Now, if you take the strategy of buying a property for the long term, potentially you might even say, I'm going to buy and hold forever. Don't worry about capital gain because it only crystallizes, as Derek said, when you sell the property. Well, I also explained to you how important it was to have enough cash flow to be able to continue to hold that property when things change in life. You know, who would have predicted 2 years ago we would have had a pandemic that's still going on 2 years later? So that extra 5 grand in your pocket, you know, over say 5 years, that's an additional $25,000. You can do a lot with that. Okay. Obviously, we're using small numbers here. Multiply that out, and it's going to make a big difference. All you have to remember is that that will eventually come back when you do sell the property, but at half. So you've saved $5,000. You've got that in your pocket today. And say you sell the property in 10 years' time, instead of paying that 5 grand that you saved today, you'll only be paying 2.5 grand more than you paid before. Okay, very simple. All right. Anything else you want to share with our listeners, or do you think we've covered enough on taxes?
I think that's too much already.
Too much already?
Yeah, I think that's too much already.
All right. Now we might do this again because I know we've gone through a lot. Hopefully the whiteboard did help you get some numbers. My writing was particularly messy today. I will try and be a little bit better in future. If you've got any more questions, drop them in the Q&A, the chat, the comments if you're on Facebook, and we will go through those and come back to you as soon as we can. But I think that's it. You know, we might try to perhaps give a bit more detail on some of these examples, and we might even pre-do them and show them to you and share them on the screen, but hopefully that gave you a good insight.
Just one thing I might want to add is when you get the depreciation schedule report, make sure you get it from a qualified quantity surveyor. Like this specific guideline, the ATO says you can only basically get it from a qualified QS or a builder. You can't get it from like a accountant
Uber driver
or a valuer. Like, yeah, exactly.
Okay. So again, remember what Lucas told us just in the session before, get professional advice, get someone who's appropriately qualified to do this type of report, and not someone that says, oh yeah, she'll be right and knocks it together, because it can lead you to trouble down the track. And there's no point in thinking you're saving money if you're not really in it.
Yeah, correct.
Okay, great. All right,
thanks.
Thank you. Good to have you on. All right, so that is it. I believe we've gone a little over time. We have, in fact, we've gone quite a bit over time. So before I let you go, hopefully most of you have still got another few minutes in your lunch break. I want to just give you some closing comments. We touched on it before where I talked about if you got value out of today, you sort of think, yep, that framework makes sense. how do I move forward and how do I apply that so that I can, sort of keep moving forward and actually get value and achieve what I haven't achieved. So we're a quarter of the way through the year. If 2021 wasn't quite the year that you wanted it to be, well, make sure that 2022 is. There is still plenty of time. And if you have the right framework, the right understanding, you really, really can smash those goals this year. So moving forward from here, you've got 3 choices, okay? Now, as much as I'd like to say, what most of you are going to do is you're going to do nothing, okay? Now, I don't mean that in a rude way. I'm not trying to be bad. It's just simple. If you're busy, if you don't have time, if you don't believe what I'm saying, you're going to do nothing about it. But I just caution you for this. If things are great, well then fantastic. I'm really, really happy for you. But if they're not, or you're hoping that you could have done more last year, just remember, if you don't make a change, don't expect a different result. What I hope most of you will think about doing as a bare minimum is take on board what we've discussed today, watch some of our back episodes, think about those 3 pillars, think about how do you take back control and go out there and apply those methodologies and do it yourself. But what I hope some of you will think about doing is do the 3rd method, which is do it with us. So as I said at the top of the show, Salvo, what do we do? Well, we do a ton of different things. We've got a heap of different businesses under our umbrella, but ultimately we're all about helping you create a home. So I guarantee you that we can help you and we can fast forward that journey and we can help you get unstuck if you are stuck. We can help you better understand the framework so that you can ultimately take back control and smash those goals in 2022. Now, quick disclaimer, before I tell you how we can help you do that, we're not going to be a right fit for everyone. So I'd love to say that we could help everybody, but you need to actually be motivated. You need to be confident. You need to be able to take action, understand the concept of building up your own database of actionable knowledge and wanting to take back control. And ultimately, you've got to be able to roll your sleeves up, get involved, and get it done. Now, if you're still listening to me now, I guarantee that describes all of you. Perhaps the people that logged off after 5 minutes might not be able to say they do that, but it's really just at the end of the day, we want to work with the people that are prepared to take the steps and get action solved because we can't help everyone. That's just a reality. And we want to really, really work with the people that are focused. So how can we help you? Well, I know very, very little about you. Perhaps I've seen your name, maybe your email address. I was reading a lot of your questions there, but ultimately for most of you, we haven't met you before. We know a little bit about you. So how can we really help you move forward and do it in a way that I can give you a guarantee that if you do take this step, that you'll actually get something that you can implement immediately. I've thought long and hard about this, and the best way that we can do that is to meet up one-on-one. So we can do that in person, we can do it over Zoom, we can do it over FaceTime, we can even just have the old phone call. Now, we're talking about 15 to 20 minutes time only, and it's a really, really straightforward process. You'll meet with someone from my team where they'll get to know a little bit more about you, get a better understanding as to where you may be stuck and how we might be able to help you. Now, the idea behind this is once we understand a little bit more about you, we can help prescribe the right solutions. But what we will do straight away as well is we'll give you a couple of things, at least 1, maybe 2 things that you can do immediately and implement and see results straight away. So the reason why I say that is really, really powerful. What I'm asking you to do today is to set aside 15 to 20 minutes of your time. That's not a lot, You probably spend more than that walking down to the local coffee shop, waiting in line and getting a coffee. So perhaps don't have the second coffee tomorrow. Book one of these sessions, and I guarantee you that after that session, you'll have something you can immediately implement. And then I hope that we can work long-term together with you. But even if we don't, and you work out that it's not the right fit, or we might say that we can't help you, we will give you something you can immediately go out there and take action with and see those results. How do you do it? If you're excited, there's 3 ways that you can do it. 1, if you're on Zoom, jump into the chat and you'll see the link there. Your browser should have redirected to here. Or the 3rd way is if you've registered with your email, I'll send you a follow-up email. I think for those of you on Facebook, it should be somewhere there on the homepage or in the comments. Again, anyone that can't find that, just reach out, drop us a line, however you prefer to message us, and we will send that through, or we can even book it for you. Now, before I let you go, I want to just share a little story for you, and I want to tell you why this is so important. Now, this was me and my daughter in Hamilton Island in July last year. Great part of the world, and it was really, really good to get up there from the cold Melbourne winter. Now, this photo almost didn't happen. It was, I think, on about day 2, and my daughter Isabella said to me, "Dad, I'd love to go watch the sunrise. Can we do that tomorrow morning?" I said, "Great, sounds fantastic. Let's do it." Now, for most of you know, the sun rises in Queensland even earlier than it does here in Melbourne. So I had to set my alarm for about 4:30 a.m. Now, we all know how annoying that alarm is. It goes beep, 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 beep. And what do? We all hit snooze, okay? I'm guilty of it. I know everyone on the line today would have done it. Those of you that are even guiltier would have hit stop. Now, the reason why that's important is that how many things are you missing out on because you're hitting snooze? So for me, I hit snooze. It went off again. I looked around, no one was awake, and I hit the dreaded stop button. But I managed to save myself because a minute later I thought, no, let's get up. I woke her up. We ran to the top of the mountain. We got this amazing photo. She had a great time. You can see the joy in her face. And it was one of these memories that as a parent and a father, I'll have that for the rest of my life. And I'm so glad that I made it happen because, you know, when you have teenagers, that's it. They don't like you anymore. They never want to do anything together. They hate you. And it takes, you know, a good 6, 7, 8 years until they start to come back and want to love you again. So this is a really, really great memory that I had, but it so nearly didn't happen. Now, why am I telling you this? Well, I want you to think about it for a moment. And I want you to think about all the things that you're not doing or that you're putting off until later, and think and ask yourself, why are you doing that? Because you don't want to miss out, because it's the people like me and what I did with my daughter last year that are actually going to get those great memories, get those results. So if you're thinking right now, yeah, no, look, I'll do this later, I'll do that later, I'll do it later, just remember, later equals never. So don't procrastinate, don't hit the snooze button, jump on, book one of those sessions with someone from my team, because I guarantee you, we're only asking for a very small commitment and you will walk away far, far better than you were when you started. All right, I'm going to give you a moment to book one of those, but I want to thank everyone for joining us today because I know there is a lot to do and everyone is always busy. So I appreciate, as always, hopefully you got to finish your lunch and hopefully we're getting you out just before 1:30. I know we went over time, but I think some of those tax discussions and those examples were useful for hopefully all of you. So once again, thank you very much for your time. And I look forward to seeing all of you again, hopefully next week, next month, next quarter, whenever it is. Join us 12:30 every single Wednesday, rain, hail or shine.